Hey everyone, how you doing today? As we do every Wednesday, or we try to do every Wednesday, we talk with Matt, the mortgage guy. How you doing, buddy?
I'm doing good. Hopefully, there's no new wrinkles or gray hairs with the, crazy February we had in
Yeah.
mortgage.
One of the reasons, folks, I have Matt, the mortgage guy, on this is if you follow my channel and you've been following it for years, I talk about two things: the consumer and cost of capital. And Matt, the mortgage guy, is my expert for cost of capital. We've seen a roller coaster ride in the last 7 business days. And before we get into what all that means, why don't we just talk about what the roller coaster that you've seen, Matt? I'm assuming rate sheets have changed several times over the last 7 days. So give the audience a flavor of just how wild the ride's been.
Sure, and I think it's one thing to get granular and for us to talk about wild rides in mortgage. I think before I even get started on that, let's just say mortgage rates are still near historic lows. If you're 3% or 3.1% on a 30-year fixed, don't feel like the sky is falling and that you need to panic, because it's definitely not that. And I'm surprised that there hasn't been more mortgage headlines like that, because that's the stuff that gets clicks and that's the stuff that people generally like to see. But I haven't seen a lot of them, which is good. We don't want consumers to feel panicked. But on the day-to-day, where mortgage rates change daily, we usually don't see big upticks or downticks in rate from day to day, like we saw basically the middle of February through the end of to current, right?
Yep.
And it was once we had about a week of declines, and it was incremental but combined,
But
quite
orderly.
a big shift.
Yeah.
Yeah, and for people, I don't want to get into basis points and being too specific, but your rate on a 30-year fixed might have gone a quarter, 3/8, or even 0.5% worse in a 2-week period. That doesn't happen. The last time anything close to that had happened was 2016 elections, when you go back and you look at like what's happened with mortgage bond trading. And so that's a fairly big shock. And I think it was an especially big shock this year because there's so much mortgage volume.
Yeah.
It's one thing to have a market where, there's an average number of mortgages being written. When you're in a super low rate environment where everybody's refinancing and, despite low inventory, tons of people are still buying, and then you inject volatility into that, it can cause more havoc than normal, I think.
Yeah, I think there's a couple things I'd like to point out, right? I've been following the consumer and cost of capital for the better part 2.5 decades. And you're right, the mortgage rate in the bond market, generally speaking, isn't the most volatile things, right? It is certainly trends, and it certainly, has its up trends and its down trends. I would argue we've been in a downtrend on rates for, well over a decade, with some hiccups in 16 and 18 and all of those. But generally speaking, they've been going down. I think at some point, it may be now, it may be in the future, we will reverse that trend and they will be heading higher, right? Whether it's inflation or growth or whatever you want to call it, right? I don't see rates on the 30-year going from 2.5 to 1.5, for example, right? There's some kind of floor where it costs money to do these loans. So I think we're closer to the bottom than the top, obviously. The other thing, you're right, is the psychology. I have been watching the consumer for so long. These are some interesting things to talk about. First and foremost, if rates tick up, a quarter or 3/8, the refi market is going to feel it first, right? That's where you're going to feel it first. But you know what happens to buyers? Buyers in a market, and I saw this in 06, I saw this again in 16, when rates tick up, it actually pulls forward demand, because the people on the sidelines who have been waiting go, oh my God, I don't want a higher mortgage rate. Because again, people buy on payments. So it's actually interesting that, if we were to reverse the trend on the 30-year mortgage, at least in the short term, 6 to 12 months, it will pull buyers forward, which I always thought was interesting.
Right. And being somebody with boots on the ground, talking to consumers every day and writing mortgages every single month, I can tell you with absolute certainty, you're spot on. Because for whatever reason, the trending down and being fairly stable, everybody's just, I'm thinking about buying or whatever. That tick up basically injects a sense of urgency.
Correct.
And so now all of a sudden it's like, oh my gosh, I just talked to you last week and my payment was 26.25. Now it's 27.10, which, isn't huge, but now the psychology that somebody has is, well, if it went up $85 one week, it can do the same thing next week and the week after. Before my payment is over 3,000, I've got to go out there and buy.
Yeah.
And so, that stuff isn't likely to happen, but it is a kick in the pants or a little bit of sense of urgency for somebody once they start to see that. And you're exactly right. The same thing will happen with refinances. People that you've talked to for months, and I've shown them this thing makes sense. It's going to save you $375 a month and it cost you this. It's a make sense deal. Drag feet, drag feet, drag feet, drag feet. One hint of rates going up. Oh my gosh, maybe I should actually act. Right. And so I think with the volatility, anybody who's in the mortgage world is just fielding, a crazy amount of phone calls from people that were dragging their feet and now want to refinance after you've talked to them for 3 or 4 months. People that were in the market that were kind of, I think I want to buy. I'm prepared to buy. I'm fully pre-approved, are now like, oh my gosh, while we have 3% rates, I want to get in because I don't want to see it go to 3.5. Which, in all honesty, if somebody buys in 6 months from now and the rate's 3.4, it's still a great looking rate. Real estate is still an amazing long-term asset. That stuff doesn't change. But, part of it is people have gotten so used to these low rates. They've been spoiled, and the average consumer doesn't really understand all the mechanics that, like, rates are being artificially suppressed.
Yeah.
Like once some levers come off and there's not, billions of dollars of mortgage bond buying from the Fed, like you let off a couple of these levers and you got 4.5% rate. And like people are like, what happened?
Yeah. I hope people hear that, because I've been talking that a lot, that now's like 2021 is the year. If you're looking at single family investments, you want to get, and you still can get cheap 30-year money, now's the time. Because again, I believe the Fed is just about to announce what has been historically called Operation Twist, which was done twice, once in 1961 and once in 2011. What they're going to do is they're going to buy the long end and sell the short end. That's going to raise rates on the short end. It's going to bring rates down on the long end. Long end is the 10-year and the 30-year. That's going to flatten the yield curve. It's going to make it harder for banks to make money, but it's going to keep that rates low. They can't do that forever. They will get out of the market. And when that lever comes off, the yield curve is going to skew higher. So folks, now is the time. And then like 2 weeks ago, Matt, we talked about rate locks, right? You're not locked until you're locked. So don't blame your mortgage broker if you didn't get locked or didn't complete the application. Let's not forget that. It's not their fault. If they had a magic wand, Matt would lock you in all the time, but he can't do that, right?
Yeah, I actually added something. I send out estimates all the time, probably do 100 plus per month. And it looks exactly like a loan estimate. It mirrors it so that I'm super transparent. People can see everything on there. I added with, highlighted star, 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 based on today's rates change daily. Just because
big red letters.
Yeah, because what happened was, the first 2 weeks of February, we saw amazing rates. And I think February 11th was the first day where we saw, the start of mortgage bonds trending down, meaning rates going up. And so, yeah, if I quoted you on February 8th, but we didn't get an application till the 15th and we didn't submit it till the 18th or whatever those dates were, I can't go back to the 8th and lock then. I can't go back and buy you a lottery ticket from February 3rd. The sales are over.
Yeah, exactly. The other thing we need to talk about in the real estate market and the mortgage market, where I think this impact is going to be felt and actually can turn some yes answers to no answers, which is unfortunate, is new construction, right? New construction is out 6, 9, 12 months in some parts of the country. And, lots of people are getting pre-approvals and all of that to be a buyer. But if rates change enough, and oh, by the way, prices go up because costs are going up, there may be some people who are lined up thinking they're going to buy a new home that won't be able to, right? Debt to income or whatever it is. If rates tick up enough, I think that's going to happen. What do you think?
Yeah, for sure. And I don't know if it was a conversation me and you had or somebody where I thought about this before we actually saw an uptick in rates, because I had talked to people who had called me and say, hey, do I have to use the builder's lender? I'm looking at it. I want to compare. And I kind of told them, let's look at that 60 days before it's completed or 45 days, because you really can't do anything now. You're at the mercy of the market. So I've had dozens of those conversations. And then I thought to myself, you know what? They are at the mercy of the market. What if rates go up a half a point?
Yeah.
And, knowing what I know about qualifying people, you ideally don't want to be at the very top end of your range of what you qualify for. But for some people, it is what it is. They've got student loan debt, or they've got a car payment with 15 payments left, or whatever it is. Like, they just have to buy with a debt to income ratio of 45%. Well, that debt to income ratio is going to change if your payment goes up because the rate goes up. And so tons of people, and when I put out a video on Saturday about rates going up, I got tons of comments, and I've got email box flooded with help. What do I do? I bought a new home that's not ready till October. I can't lock. And so I guess, before I give my opinion on it, advice for people out there: talk to whoever you're in contract with and whoever your lender is, because builders that are smart, I think, that know that it's taking 6, 9, 12 months are going to have lenders that have options for longer rate locks. And I've learned so much about this in the last week, just talking to people. There's all kinds of stuff that lenders are doing where, hey, if you're willing to pay a little bit up front, we'll give you a 180-day lock. Mm-hmm. And it's always more expensive because it's, it's for the lender, it's risky and whatnot. And so you can pay a half a point to get this extra long lock. And sure, it costs something, but it allows you to have some certainty. Mm-hmm. And if you're one of those that is not going to qualify if rates are 3.5% in December, mm-hmm. then, certainty might turn into necessity. You might have to do that. And so every lender's different. Some offer 90, some offer 180. I don't know if I've heard of anything longer than the 180-day lock that I talked to somebody about recently, but it's a real concern because, you've got a big earnest money deposit on a lot of these new builds where you're putting down $10,000, $15,000. I've known builders to not be so kind about giving refunds. Mm-hmm. And I don't know what they would do in the circumstance where you say, hey, Mr. Builder, I know I have a non-refundable deposit, but I don't qualify anymore. Like, what am I supposed to do? Yeah. And so, it's something to definitely look at. If you're at the top of that range and, you're buying a $500,000 or $600,000, $700,000, $800,000 house in California, it doesn't take a lot in rate. I mean, a $500,000 mortgage, 0.5% is $2,500 a year, which is $200 a month. I mean, wow. It can shift on you.
Yeah. The last thing we'll close out on this conversation about mortgages is kind of where you were at in the beginning. And that is, we're still at historic lows. I think anything with a 3 on it or below, whether it's an owner occupied or investment loan, is going to be tremendous loans when you look back on it in 5 or 6 years, right? My opinion only is go get that 30-year money fixed as long as you can. As long as it's below 4%, you're going to be happy. Again, I was doing deals in the 6s and actually did one in the 7s back when I got started. So, appreciate where we are. Did you catch the bottom? Yeah, very few people do. Make sure the numbers make sense. Be conservative. Put a little extra down if you have to. But still, keep investing and buy and hold real estate is kind of my feedback.
Yeah, for sure. I feel the same way. And I remember the conversations in 2019 where it's just like, hey, listen, if you can get money under 4%, you were doing really good. Yeah. And the same still holds true. It's not any different. When rates were 5 and they come down to 4.25, it's like, wow, near 4% on a 30-year fixed loan where you're, having tax advantages and stuff of owning real estate. Like, this is great. And so people have become spoiled, but don't lose sight of the overall picture where it's still fantastic.
Yeah. Having a 3% mortgage in a 3% inflation environment is going to be pretty good when you look back on it, just simply said.
Right.
Yeah.
Free money.
All right, man. Any closing thoughts? How can people get a hold of you if they want to buy a home and buy a refi home in California?
Yeah, if you're in California, I'm happy to help. If you're outside of California, I'm happy to share a referral. If you just send me an email, Matt, M-A-T-T, @mattthemortgageguy.com, me or somebody in my office will connect you with either an out-of-state broker who can help you out there, or if you're in California, happy to chat. I appreciate everybody from One Rental at a Time that's reached out. Got a couple deals in process, had plenty of good conversations, and it's always fun to talk to investors, live vicariously through investors, and talk through knowing what I know, what I do, because sometimes people who are uncertain about, a strategy when it comes to real estate investing or a strategy with their mortgage, it just takes a 5 or 10 minute conversation to kind of work through some things. And I'm just there as the facilitator. The consumer eventually decides, and I'm just letting them, I'm hitting the tennis ball back, and we go back and forth, and they go, okay, it's clear now, Matt, here's what I want to do.
That's awesome. Playing tennis with them. I appreciate that. Thanks for all you do. Have a great week. All right.
Cool. You too. Thanks, Mike.
Mm-hmm.